Hello and welcome to the National Real Estate Post. Frank Ray here. We have our good friend Barry Habib waiting to join our conversation here, and we wanted to get things rolling with a little bit of housekeeping. Just stay with us real quick, guys, because this video is going to be great for you to actually share with your potential buyers out there. This is a good one. So hang tight. Just real quickly, Barry, I just want to let you know we do have Liberty Home Equity Solutions out there this coming Thursday, next Thursday, the 26th, I should say, doing another webinar on how easy it is to get started with reverse. And not only that, but they're going to kind of pop the hood and let you see just what kind of money you can make. And the cool thing about these guys, Barry, is that they have different levels of participation. So you can get started with them almost just a referral basis and take it as deep as you want to go with them. And of course, pay structure changes with that. And that's what they want to show you guys. The other thing I want to bring up about this is, everybody's trying to look for a place to get some more business, and the reverse mortgage market with all the new guideline changes is much safer, but it's a huge, huge market that nobody's tapping. So I'd really encourage you guys to click the banner you see down below, over on your right to get
10,000 people every single day turn age 65.
Yeah, every single day. And the amount of equity that's available out there for them to improve their lives is what's going to happen with these products is incredible.
Well, what's happened with all the appreciation we've seen of late, it's created a lot of wealth trapped in homes. So this is a really good area.
And speaking about ways to get more business, we're doing a webinar with you with Angel Oak. Again, we did one before. Give us real quickly, just a little bit of information. This is on May 3rd, guys. May 3rd, the banner you see up on your screen is over on your right. Register for May 3rd. But Barry, what are we going to talk about a little bit there real quick?
Well, yeah, the folks at Angel Oak, they're great. And they've got some ways for you to make a lot more money and really endear yourself to realtors and put together transactions that wouldn't be put together. The thing of it is that, look, we know their sweet spot are transactions that just miss. They don't fit the qualifying standards that you normally would have. So what we want to do is show you really the opportunity that exists in real estate, and using some really creative and wonderful tools that customers seem to love because it's making a big difference. That's why we're doing this again, is that you can show people that even paying a little bit higher rate just to get in the door, you'll be very well rewarded based upon appreciation in your specific market, based on cash flow, based upon the benefits that you receive through amortization as well. And of course, if there's a tax benefit from time to time that you may see, you're going to create a lot of wealth even at a higher interest rate than if you stayed on the sidelines. So this could be really valuable for people and help real estate agents tremendously as well.
Yeah, so that's on May 3rd. The banner is up on your screen. It's over on your right. Click on that, and Barry will teach you all about that great stuff. And it's a great webinar. We had a great one last time, so it was super. So today, Barry, let's go ahead and move on to the meat of the show here. And we were talking a little bit. We had done a show earlier where we were found a survey or a study that showed the percentage of people who are renting in the major metro areas, what percentage of the renters out in those areas could actually afford to buy a home. And overall, there was an average, I think, of all the major metro areas, around 25% of renters out there could actually afford to buy. With respect to affordability in that report, though, you had some thoughts on that. So I was wondering if you could share some stuff with us.
Well, yeah, you guys did such a great job of helping people realize that and see that report. And you're 100% right. Yeah, you nailed it. 25.26% is their national average, but then they broke it up to different MSAs and showing you specifically what is in some MSAs. But if we just take, like you said, 25%, what does that mean? That means that 25% of people who are currently renting are doing so, but could afford to purchase a home. Now, think about that. The national percentage of people who are renters is 37%. That's the home ownership rate is 63%. So 37% renters. Those 37% who are renting, if you took 25% of those, it means slightly above 9% of the population in your market are currently renting, but they could actually afford to purchase a home. So if you have 1 million people in your marketplace, you're talking about 90,000 people who could actually afford to purchase a home but are choosing to rent. Now, there could be reasons why. We understand that, and not every market's the same. But you'd have to wonder why they're renting if they knew the benefits of home ownership. And so many times, you've seen us do this, and we've talked about this, and we have a really good tool for illustrating the benefits over time of home ownership. The numbers are astounding. It could be $100,000, $200,000, $300,000 benefit to purchase a home as opposed to renting when you break it down correctly with the data we have for appreciation in each individual county. So what we're able to do is show them that you'd wonder, once somebody saw, hey, I'm $200,000 better, if they only knew this information, they probably would choose to own instead of rent. You can assume that the vast majority of people who are choosing to rent, who can afford to purchase, are doing so just because they don't know. And if the folks listening to this are able to help those individuals out by breaking it down for them and letting them see that, you probably would have a lot of success in converting those people into homeowners.
You know, and that 9% is really a pretty darn big number. Like you said, I mean, if you're in a marketplace, you got 1 million people, that's 90,000. But even like in my neck of the woods, we're a pretty small town. You know, we've got 100,000 people here. That's still nearly 10,000 people that are renting here who could afford to buy, only if they knew that they could do that. And I think, you know, it really comes down to us just getting the word out and letting people know that these are the statistics. Do you happen to fall into this bracket of this 25% that can actually buy, and maybe you just aren't aware of it? And to get that word out, I mean, I would certainly suggest getting the word out through, you know, I'm going to fall back on Facebook, and I know it's, you know, almost becoming a little cliche to work with Facebook, but guys, in Facebook, you have local community groups. In Vacaville, for example, we have Vacaville Crime and Community, and there's like 30,000 people in that. And this is just a bunch of people who live in my town, right? Who, you know, we talk about our town in there, and there's other community groups in your area that if you join them, you can start spreading the word a little bit, maybe putting on some classes or, you know, holding some webinars, that type of thing.
Just display a version of our buy versus rent tool and show the benefits. That's essentially, there's several people that what they do is they exactly do that, because you can be very specific with your Facebook audiences. And if you learn a little bit about Facebook marketing, it is so effective to do so. It's really the only marketing that you probably need. And you're able to then target these audiences. And if you share things like a buy versus rent tool as an example, you're going to get interest from people. And then being able to give them the specifics and the details in their marketplace, they'll want to potentially move forward. And then it gives you control to give real estate agents that lead. Or if you're a realtor, obviously it gives you the ability to work with them. You know, there's a lot of rental only realtors that many mortgage originators that we provide this to are going after rental only realtors and saying, hey, you've got a big database of renters. Why not have them take a look at this? And Frank, I wanted to point out your example that you just said. You said, okay, 100,000 people, it's a relatively small town, and 10% of those would be 10,000 people. Heck, what if of those 10,000 people, you know, if you just said 10% of that, it's 1,000 people. What if you said 2% of the 10%? Okay, it's 200 people.
Yeah.
200 more transactions?
It's a good deal.
What if it was 1% of the?
I know, yeah. So you know what?
20 transactions? Yeah, there's a lot of business is the point.
I love you're so right. There's so many property management companies connected to real estate companies, and the truth is, the reason that they do this is they want to flip those people into deals. You know, they handle the rentals for now, but they would like to take those renters and move them along and get them to buy a home. So they're going to make more money there. But to be able to approach them and say, you know, 25% of the people that you're working with right now are qualified right now. Maybe we should get some marketing information out to those guys and have me pre-qualify them for you.
It's an absolute home run. And then look, then comes the, you know, are they qualified? Is affordability itself an issue? We hear this a lot, and the media loves to play this up. And the media loves Frank to talk about, oh well, home prices are rising. Let's take last year's numbers. You know, home prices rose 6%. Now this year, thinking maybe 4.5% to 5%. At least that's our estimates, about 4.5%. So if you used a round number and said 5%, people say, well, you know, the statistics show that incomes are rising 2.9% year over year. If home prices go up at 5%, there's a disconnect. Here's a couple of things that we need to understand so we can explain this, okay? So first of all, on that 2.9%, that's everybody. Everybody's not in the market to buy a home.
Right.
If you take the bottom quadrant of earners, these are your people that 16-year-old, young gal, young guy, they're not ready to buy a home. They're out there with a part-time position. They're working hard. They're doing great. But, you know, maybe they're working at a fast food restaurant. Maybe they're doing something because they're just getting started. They're doing wonderful things that they're working, but these aren't the people that are yet ready to purchase a home. If you took that quadrant, their incomes went down 2.5%, believe it or not. I don't know why they went down, but they did. Now, if you took the three quadrants above that, which now are people that could potentially purchase a home for real, their incomes went up at 4.7%.
Ah.
So overall 2.9, but the people who are in the game 4.7. Now you might say, okay, well, if homes go up 5%, 4.7, it's still a little light, or it went up 6%, it's still a little light. Well, here's the thing. It doesn't have to go up dollar for dollar because you don't use all of your monthly income for all of your housing debt. It's usually a percentage of that, whether it's 20%, 25%, 30%. That percentage is the amount that you need as an increase. So in other words, if you're using, let's just say, a $5,000 a month income, $1,000 a month payment, if that's the relationship you have for principal and interest, if the principal and interest went up 5% on $1,000 of payment because home prices went up 5%, you missed it. Well, that means that it would cost you, instead of $1,000 a month, if interest rates stayed about the same, $1,050 a month. Okay, so you went up $50. If you're making $5,000 a month, how much would your income have to have gone up to cover that? Not necessarily keep ratios the same. It'd have to go up 1%.
1%. Yeah.
Maybe I'm oversimplifying it. So maybe it has to go up 2% or 2.5% or whatever it is. It doesn't have to go up on a one-for-one basis. And therefore, you're a lot closer on affordability than you think.
There you go. So we can direct, so I'll put a link down below to MBS Highway where those guys, if you guys aren't already a part of it, you can try it out for a couple of weeks for free, and you can get these. The
Buy versus rent.
The buy versus rent charts, and a whole lot of other stuff is in there that's going to just blow your mind that you'll be able to use for your marketing like this. So we'll go ahead and put that link down below for you guys. But this is a great idea to get the word out. These are great thoughts on how to do it. And I think if you get the word out, there's great opportunity out there for you guys. So, and
hey, familiarize yourself, like Frank is saying, with Facebook marketing, because it is extraordinarily powerful. And Frank understands this, knows how to do this stuff. But you can get your feet wet with it. You can do some research if you'd like online. These are the types of things that today's loan originator really needs to be on top of, and today's real estate agent needs to be on top of, because there's creative ways to funnel lots of leads to you based on the tools and data that you have available.
Awesome. Well, thanks for being on the show, Barry. You guys do us a favor, leave your comments down below. I'm sure Barry will chime in if he can, if he has time to answer them. So Lee, and do us a favor, forward, share, and subscribe, and go find these potential buyers.
Go get them. They need you.
They're out there. They just need to be informed as to what they can do. So find a way to do it. You guys have a great day. We'll catch you later here at the National Real Estate Post. Okay.